The 4% rule gets talked about like gospel in retirement planning. But let's be honest, it's always been more of a rough guess than a golden rule. Now its original creators are revising it to 4.7%. So does that mean your retirement paycheck just got a raise? Or is it just another headline that oversimplifies a complex decision? On today's episode, we're going to talk about retirement breaking news. The 4% rule gets a makeover.
Going to be a great episode today on Your Retirement Elevated. Walter Storholt alongside financial advisor Scott Dugan of Elevated Retirement Group. And yes, Scott, I'm excited that you've brought this topic to us today because I've certainly heard about the 4% rule pretty religiously as I've been in the financial world for the last decade plus. And all of a sudden it's changing. It's the 4.7% rule now.
Yes, it's gone through some iterations because not too long ago, they adjusted down to 2.7 to 2.9 when interest rates were extremely low.
Yeah.
And so this is our third revision and bringing it back up, to 4.7. And that's really due to, interest rates being back up and, just stock market historical growth rates. And so if we give a little history, kind of the basics of the original 4% rule, it was proposed by William Benjamin in the 1990s. So he was an advisor. And the study suggests retirees could withdraw 4% annually, adjusted for inflation, from a balanced portfolio of 50% stocks, 50% bonds. And that's over a 30-year period without running out of money. And it's based on historical U.S. market data and designed as a safe withdrawal rate under worst-case scenarios. So that's the foundation of it. So in 2025, he's updated that to 4.7%. So his new recommendation, now it's looking at with more asset classes and a 55-45 stock to bond split.
Okay.
So you could potentially start withdrawals at 4.7% is what his research shows. And now this is assuming we've got a diversified portfolio, regular rebalancing, and a long retirement time frame. So it's really meant to reflect today's data and planning tools. And again, it's definitely not a one-size-fits-all answer. If you've been watching this channel for a while, if you've ever been to one of my university education classes, I don't like rules of thumb. Here's why. The vast majority of the rules of thumb that are out there are for the majority of the population. And if you've been listening for a while, you know that the average 65-year-old retired couple is living on 2 Social Security checks and has right at $100,000 saved for retirement. A lot of these rules are for that specific demographic. That's not everyone. That's definitely not who our firm is designed to help. And so we're very careful with dispensing these basic rules of thumb, Walter.
Yeah, I bet you are. And the secret to me is, as you were giving that description of this new 4.7% rule, is it had all these like all of these little, I don't know, little bit of like side
little
caveats, right? Assume a diversified portfolio, regular rebalancing, long retirement time frame. Like, so all these other things have to be true for this rule to actually then make sense and apply. But Scott, a lot of people are going to see that article or any of the articles that kind of come out about this number, and they're going to think, well, this is a green light that I can spend more. If I'm withdrawing an extra 0.7%, I'm spending more money. I'm in good shape. I got a raise.
Pedal to the metal. Let's make this happen.
Yeah. So, I know that probably makes you cringe a little bit, right?
It does. And, this increase isn't a blanket permission slip. It definitely depends on returns, inflation, your personal goals. Now, it's a theoretical improvement, not a guarantee. And it's still based on historical backtesting, not future certainty. Look at back episodes, we have looked at, what retirees actually do, how their spending looks. I have rarely seen someone that starts out spending 4% of their nest egg, increasing it by inflation every year for the rest of their life. It's never worked that way. I've never seen it. The data doesn't say that holds true. And if you go back and watch previous YouTube episodes, you'll notice that in those first 10 years, you see this income, and that's usually their highest income spending is first 10 years of retirement. In that second decade, it starts to decline a little bit. Actually about 15% over a 10-year period. And that last decade, usually in somebody's 80s, it trails off a little more, barring healthcare, then it can definitely hockey stick up. So it definitely, I think in summary, if you're asking a question, should I adjust my retirement income strategy now? Well, potentially, but it depends on what you based it on in the beginning. We like to look at in segments of 10 years, the go-go, the slow-go, and the no-go. We know the go-go years are going to be the highest expenditures. Some people spend more than 4%. Some people say, I'm going to spend 5-6% for this 10-year period, and I'm going to taper off over time. Some people say, hey, the first 15 is going to be this way. Heck, I've got a client that he wants to spend as long as possible, but he's put some very important safety nets or guardrails in place where when he reaches his late 70s, between his pension, his 2 Social Security checks, between he and his wife, he's got several guaranteed income annuities that are kicking on that will guarantee income for the rest of his life. So he's able to spend now from his brokerage accounts, his IRAs, his stuff at Fidelity, because he knows on the back end, it's all guaranteed as long as the pension, the Social Securities, and the annuity companies continue to produce those assets. So again, don't rush to change your plan based on one article or study. That's not good business. Now, obviously, a higher withdrawal rate may sound good, but again, it also raises your risk, and it depends on your personal situation. But this is a good moment to revisit your plan, not rewrite it. And that's the thing about a plan. You always want to be constantly looking at that plan and making adjustments. So does it mean it was wrong? No, it's always a starting point, not a personalized strategy. I view it as a back of the napkin calculation. If someone says, hey, when I retire, I need about $50,000 in income to supplement my Social Security. Well, back those numbers out. Use a 4.7% distribution rate. Well, we need over $1 million to get that $50,000. So it's a good starting point. How much do I need to save?
If it gets the conversation going, it's doing its job as a rule of thumb at that point.
Yes. So again, what we really need to focus on is what factors matter more than the percentage that you withdraw. And I'll tell you, it's retirement timing, the market sequence risk, sequence of returns risk, taxes are a big one, longevity and flexibility all definitely carry more weight, more than a fixed percentage. And your plan should definitely allow for adjustments. That's why the idea of locking in a fixed number is probably not the best avenue to go down. We would rather establish guardrails you're comfortable living between and making adjustments as needed. So again, that's where you consider these strategies like dynamic withdrawals, guardrails, income bucketing, all things that our team is very adept at and use. It depends on what personality you have, what goals and desires you have, what resources. All those have pluses and minuses or strings that are attached. So again, ask yourself, what's your personal safe withdrawal rate? Again, that's the real question. And there's no universal answer. There's no cookie cutter way in our world to do that. Again, it depends on the portfolio, your health, your tolerance for risk, your goals, all those things get factored into it. And that's really with working with a qualified professional helps you dial those things in.
Is your retirement strategy working as hard as you are? Get the answers you deserve with Elevated Retirement Group's information-packed toolkit. Inside, you'll get Scott's book, Exceptional Retirement, along with essential insights covering the 5 key areas of retirement planning, strategies to keep more of your hard-earned money, and how to choose your winning retirement team. Take control of your retirement today. Click the link in today's show description to claim your toolkit at no cost to you.
I think that's beautiful, Scott, and a great way to kind of describe how we can interpret and understand this updated 4%, now 4.7% rule. I will say it was at least good to see it go in that direction, because like you, we'd always joked that the 4% rule, or more likely now, the 3% rule or the 2% rule, it's nice to see it have a nice little rebound here.
And again, it's a great conversation starter for sure, but that shouldn't be the end of it. It's just a start. The real value lies in building a plan that adapts, not just to market trends, but to your life, your lifestyle, your goals, and the risk you're actually facing. So if you're listening, you're wondering, how do today's headlines, how should or shouldn't they affect your retirement strategy? That means it's probably time to take a closer look, and we'd be happy to do that. My team and I'd be happy to do that with you.
All you have to do, if you'd like to schedule a time to visit with Scott and the team at Elevated Retirement Group, is to scan, if you're watching our episode today on YouTube, the QR code that you see on your screen right now. You can use your phone to scan that and go schedule an appointment, a visit. Part of the discovery process is an initial conversation with the team to see if you're a good fit to work with one another, and you can talk to experienced advisors on the team that way. We also have the schedule linked in the description of today's show, so you can find it easily there as well. But don't hesitate, schedule a time to talk, see where you stand right now. Are you closer to the old 4% rule? Are you right in line with this new 4.7%? Or do you really need that customized number to your situation? Well, there's only one way to find out, and that's to meet with Scott and the team at Elevated Retirement Group. Reach out today at your convenience and make that happen. Scott, thanks for walking us through this and catching us up on some retirement-related news, and we'll look forward to talking to you again next week.
See you next time. Thanks.
This video has been prepared for educational and marketing purposes only. The information in this video is general in nature, does not constitute personalized investment advice, and does not provide a complete analysis of the subjects discussed. All investments involve risk, and different types of investments involve varying degrees of risk. There can be no assurance that any specific investment strategy will be profitable or suitable to you. Additionally, although information presented in this video is believed to be factual and up to date, we do not guarantee its accuracy. You should consult an attorney or tax professional regarding your specific legal or tax situation and should consult a professional advisor before implementing any of the strategies mentioned in this video. Investment advisory services are offered through Elevated Capital Advisors LLC, an SEC-registered investment advisor affiliated with Elevated Retirement Group LLC. Registration as an investment advisor does not constitute an endorsement of Elevated Capital Advisors LLC by securities regulators, nor does it indicate that the firm has attained a particular level of skill or ability. Insurance advice and products may be offered by a third-party insurance producer, which may be affiliated with Elevated Retirement Group LLC and Elevated Capital Advisors LLC. Walter Storholt and Third Wheel Media LLC receive compensation for their assistance in preparing and hosting this video.